Chapter 11 covers long-term liabilities, bonds payable, and classification of liabilities on the balance sheet. The learning objectives for this chapter include to journalize transactions for long-term notes payable and mortgage payable, describe bonds payable, measure interest expense on bonds using the straight-line amortization method, report liabilities on the balance sheet, use the time value of money, present value of a bond, and effective interest amortization, which is Appendix 11A, and retire bonds payable, which is Appendix 11B. The first learning objective is to journalize transactions for long-term notes payable and mortgages payable. Recall that most long-term notes payable are paid in installments. The current portion of notes payable is the principal amount that will be paid within 1 year, which is a current liability. The remaining portion is long-term. Consider the $20,000 note payable in the previous chapter, signed on May 1st, 2013. The note will be paid over 4 years with payments of $5,000 plus interest due each May 1st. Remember that the amount due May 1st, 2014, $5,000, is current. Notice that the reclassification entry on May 1st does not change the total amount of debt. It only reclassifies $5,000 of the total debt from long-term to current. The remaining 4 months, January through April, will be recorded on May 1st. In December, 8 months total interest, $20,000 times 6 times 8 over 12 equals $800 for the interest accrued on the note as of December 31st, 2013. Now it's May 1st, 2014, and the company must make its first installment payment of $5,000 principal plus interest on the note. Recall the 8 months of interest already recorded at the end of December 2013. The accrual of 4 months interest is recorded when the first installment payment is made. The journal entry would include a debit to interest expense for the 4 months interest to accrue for January through April. It will also include a debit to interest payable for the interest accrued at the end of December 2013. A debit to long-term notes payable for $5,000 installment due, and a credit to cash for the installment payment and 12 months worth of interest. $5,000 plus $800 accrued interest at December 21st and $400 of interest accrued for the months of January through April 2014. Notice the entry debited the long-term notes payable account, not the current portion of the long-term notes payable. Why? Because each year $5,000 of the note balance becomes due or is current. When we make payments on the note, we just reduce the long-term notes payable, which is one entry, rather than making the payment and then doing another reclassification entry like we did on May 1st, 2013. The amount owed on the note is $15,000. The original note minus the $5,000 payment on May 1st, 2014. $10,000 is included in the long-term notes payable account, and $5,000 is the current portion of long-term notes payable, equaling the $15,000 total due. Mortgages payable are long-term debts that are backed with a security interest in specific property. The mortgage will state that the borrower promises to transfer the legal title to specific assets if the mortgage isn't paid on schedule. This is very similar to the long-term notes payable we just covered. The main difference is the mortgage payable is secured with specific assets, whereas long-term notes are not secured with specific assets. Like long-term notes payable, the total mortgage payable amount will have a portion due within 1 year, or is current. and a portion that is due more than 1 year from a specific date. Commonly, mortgages will specify a month's payment of principal and interest to the lender, usually a bank. The most common type of mortgage is on property. For example, a mortgage on your home. The principal portion of the total mortgage payable that is due within 1 year is current. To figure the amount of each payment to apply to the mortgage payable and how much is interest expense, we create an amortization schedule. The principal portion of the total mortgage payable is due within 1 year is current. To figure the amount of each payment to apply to the mortgage payable and how much interest expense, we create an amortization schedule. An amortization schedule details each loan payment's allocation between principal and interest. By the way, these are done. This is an awesome application for a spreadsheet. So after reviewing the amortization schedule, we would reclassify the portion of the $100,075 mortgage balance that is current as a debit to mortgage payable and a credit to the current portion of the mortgage payable for $1,228.91. The current portion of the mortgage payable is payable each year end on December 31st rather than monthly, since the change to the account is not material from month to month. This short exercise reviews accounting for a long-term note payable. On January 1st, 2014, LeMay Fenn Company signed a $200,000 5-year 6% note. The loan required LeMay Fenn to make payments on December 31st of $40,000 principal plus interest. Number 1, journalize the issuance of the note on January 1st, 2014. The issuance of the note is a debit to cash for $200,000 and a credit to long-term notes payable for $200,000. Second, journalize the reclassification of the current portion of the note payable. The long-term note payable would be a debit for $40,000. Current portion of the long-term note payable is a credit for $40,000. Journalize the first note payment on December 31st, 2014. We have interest expense of $12,000, long-term notes payable, debit, $40,000, and cash credit for $52,000.